in these holding periods. At present, commodity ETFs, again, I was talking about two commodities which we are having in the ETF space. One is the gold and second ETF, the silver. But there are ETFs in crude oil, in copper, in aluminium, and nickel and zinc. They are not just metals, as our previous speakers were talking about. They are critical, in respect of copper, they are critical for electrical vehicles, renewable infrastructure, nickel and cobalt are vital for batteries, etc., etc. By allowing the investors to invest in these ETFs, apart from gold and silver, you are giving an opportunity to the investors to participate in the growth story and also enable them to understand. And these are things which, particularly when we are looking at the risks that are involved. So what is our vision? I mean, our vision in the commodities market is to emerge as a fourth strong pillar. As we all know, today we have very strong pillars. Equity and debt markets have become extremely strong. Hybrid markets are also evolving. We want that commodity markets also evolve equally strong, and they also come to the forefront. As how do we do this? There are three steps. Again, at the cost of repetition, we're just saying, ease the holding norms. Second, broadening the commodity horizon. And third, more importantly, sir, what you are focusing upon is education, investor awareness and education program. We need to go beyond gold and silver. And they are explained to them that these commodities are hedged for inflation. They are diversifier that behaves differently from equity or debt. They are the way to product and grow wealth in times of volatility. And AMFI, fund houses, and all of us in the ecosystem must educate investors the role of commodities can play in their long-term financial journey. So ladies and gentlemen, we are at an inflection point today. In just 5 years, we have seen gold ETFs have grown from niche to mainstream. Silver ETFs have shown that a new category can scale in record time. The investor appetite is here. The regulatory infrastructure is here. Opportunity is here. So what we need now is an ecosystem where Indian investors can diversify across gold, silver, base metals and energy. An ecosystem where fund managers have the flexibility to act as in investors' best interest. An ecosystem where commodities become a familiar and trusted as equities and bonds. If we take these steps, I believe that in next 5 years when we meet, we'll not be talking about 72,000 crores in gold ETFs or 26,000 crores in silver ETFs. We'll be talking about an entire spectrum of commodity funds with trillions of rupees under management, empowering the investors to align the portfolios with mega trends of the global growth, technology, and sustainability. That is the vision, that is the opportunity, and I'm sure together we can make it a reality. Thank you and namaskar.
Thank you so much, sir. Thank you. And now I would like to invite on stage Dr. Harsh Kumar Panwala, Chairman, MCX, to address you all. Let's welcome him with an applause, everyone.
Namaskar, good morning. Good morning, sir. Tuhin Kanta Pandey for gracing the occasion and all the esteemed guests for gracing the occasion. मुझे फूल देना चाहती थी वो, मुझे कहा आपकी प्रेजेंस ही एक फूल है, क्योंकि MCX ने अपने हिस्ट्री में देखा है कि अगर मार्केट मेकिंग अच्छी हो तो उसकी एक्सेप्टेबिलिटी में डिफरेंट जगह पे दिक्कतें नहीं आती. फॉर इंस्टेंस वी हैव डन वेरी वेल इन कमोडिटीज और फॉर नेचुरल गैस एंड गोल्ड एंड नाउ इन सिल्वर एज वेल. देयर इज अ गुड पार्टिसिपेशन, क्वाइट अ डाइवर्स प्रोडक्ट ऑफरिंग्स, and the market participation even of not only retail but also of the actual users, manufacturers of gold ornaments, etc. is vibrant. My wife went for purchase of some jewelry recently. I was happy when I was along with her. They said, "Sir, MCX price itni hai." So I felt good about it because it has percolated down. So similarly, now we at MCX have decided at the board level as well as within the management, we'll play better market making role for various other commodities. The base metals is a beginning. We have a consultation with you. All these consultations will help us in ensuring that all the benefits which earlier speakers gave about standardization, reference, prediction of price in future, hedging, etc., all that percolates. But all this is traditionally why important? Why it is so important? We have known economically land, labor, raw material, finance, technology, all these factors of production play a role. And raw material basically means commodities. So if we don't do enough work, because commodities are going to play a major role, as Jain Saab had just said before, a speaker before me, that industrial manufacturing and infrastructure updation on a accelerated path requires extensive market making for commodity futures also, in addition to spot. Because we have seen wherever those fragmented spot markets are there, it becomes very difficult subsequently to even bring on platform the derivatives for that commodity also. So I think sometimes while we focus on derivatives, simultaneously we will have to work with various governments also in making, especially for agriculture commodities, spot markets vibrant, as also for our base metals as well. We are happy with your support, with the actual value chain participant support, the electricity futures with the blessings of SEBI, which we could introduce. Our open interest in MCX offering is very high and is even higher than the other exchange. So this accelerated participation in terms of market making from various value chain participants is very, very important. Some of the GST related issues which we get focused here will not only require SEBI's approval and support, but also the government's approval. Will take it up there. GST is a major chunk which affects the commodities because of diverse centers where it is there. I think regulatorily wise, let me say, from our experience in very, very recent times, is whatever product that we have sought for has been approved by SEBI. I think that's a very, very welcome change. So we look forward to more of your suggestions for new product offerings in the base metal segment. And this is non-ferrous segment, but I would even say even for the ferrous segment. You know, iron ore is consumed in various forms by even households today. I think we are committed from MCX side to offer more of such products in the base metals, which are ferrous or non-ferrous. We thank you for your participation on our platform. With your blessings and with your support, only our technology platform could stabilize. It is becoming more resilient also now. And we would improve the ease of doing business further in our technology platform and by new product offerings. And with the support of SEBI, with the blessings from SEBI, we'll introduce more of such products. We'll continue to learn from you and offer more for your satisfaction. Thank you very much. Thank you.
Thank you so much, sir. Thank you. All right, ladies and gentlemen, now we come to a very special moment, the release of the MCX Metals Report. Well, MCX takes pride in being a pioneer in India's growing commodity derivatives market, not just in introducing India's first exchange-traded base metals futures and base metals options, but also in being perceptive to the needs of the industry and evolving demands of an evolving economy and ecosystem of India's base metals. MCX has the privilege of documenting these perceptions, the impact of potential of India's base metals derivatives in the form of a report titled Industrial Strength, Financial Depth, Base Metals Derivatives Serving a Rs 20 trillion Market. Well, I have the honor of inviting our dignitaries on stage to please join us to launch the book report. We have Ms. Praveena Rai, MD and CEO, MCX. Mr. Sandeep Jain, President, Bombay Metal Exchange, requesting our dignitaries to please start joining us on stage. Mr. S. Ramachandra, Member, Governing Body, India Battery Manufacturers Association. Mr. Rakesh Kumar Jain, Commodity Participants Association of India. Mr. Venkat Chalasani, CEO, Association of Mutual Funds in India. Mr. Sashi Krishnan, Director, National Institute of Securities Market. Mr. Vijay Singhania, Past President, Association of National Exchanges Members of India. And Mr. Anup Gupta, President, Bombay Stock Exchange Brokers Forum. We have Dr. Harsh Kumar Bhanwala, Chairman, MCX. Ms. Richa Goel Agrawal, CGM, SEBI. And now would also humbly request Mr. Tuhin Kanta Pandey, Chairman, SEBI, to join us on stage to unveil the report. And to all of you present here in the gathering, we're very honored that everybody is here, and we are very happy at this special moment to now unveil the release of the MCX Metals Report titled Industrial Strength, Financial Depth, Base Metals Derivatives Serving a Rs 20 trillion Market. Let's give a louder applause, everyone, and let's keep it going. It's a special moment. Thank you so much, everyone. Requesting Mr. Tuhin Kanta Pandey to please stay back, and in the audience requesting, don't forget to take your copies of the book later. I would request Dr. Harsh Kumar Bhanwala, Chairman MCX, to kindly please join on stage to felicitate Mr. Tuhin Kanta Pandey, Chairman SEBI. Thank you. So we're very honored with your presence, and now if you could just address the gathering. Thank you so much, sir. Let's give him an applause once again, everyone.
Shri Harsh Kumar Bhanwala ji, Chairman MCX, Ms. Praveena Rai, MD and CEO MCX, Shri Sashi Krishnan, Director NISM, colleagues, industry leaders, members of industry associations, participants from the commodity markets, and friends from the media. It's a pleasure to speak on metals from mines to markets, which is fundamental to commodity derivatives market and in turn to our nation's economic journey. The journey of metal is a fascinating one. It begins deep within the Earth's crust as an inert mineral resource through mining, refining, and processing, it is transformed into a building block of modern civilization, powering our industries, constructing our cities, and enabling our technological progress. These metals have powered development from the Bronze Age to today's electric vehicles. But its journey doesn't end there. In the 21st century, metals also complete a financial journey as a dynamic financial instrument traded in commodity markets across the globe. Today, I want to talk about this very journey. This is India's endeavor to shift from price taker to price setter and from reliance to self-reliance. For decades, our physical metal markets were largely dependent on foreign price benchmarks to transact. The London Metal Exchange led the way for non-ferrous metals, setting the prices that our domestic producers and consumers had to follow. And we all know UK has very little of metals there. Our markets were fragmented with regional exchanges trading local commodities. The new millennium, however, brought a seismic shift. In the early 2000s, private entities had established national-level online commodity exchanges. Another significant milestone was a merger of the FMC with SEBI in 2015, which brought the commodity derivatives market under a unified modern regulatory framework. We have taken deliberate and decisive steps to deepen our markets and make them truly reflective of India's economic reality. A crucial step was delivery settled metal contracts, which tightened the link between the physical and derivatives market. It was a step towards self-reliance, allowing our market participants to reduce their reliance on international standards and adopt Indian benchmarks. Late evening trading has helped domestic participants synchronize with the active European and North American trading hours. Base metals underpin the story of our infrastructure, energy, and transport sectors. India's real GDP growth is expected to remain as one of the highest among the major economies in the year ahead. This brings me to my first question for all you to introspect on in today's conference. How do we broaden the acceptance of Indian benchmarks at home and abroad? The alchemist's secret, the economic utility of derivatives. Why are robust commodity derivatives markets so essential? The answer lies in their economic utility. They are the more modern alchemist's crucible, transforming the risk of price volatility into a manageable variable. First and foremost, these markets provide real-time price discovery. The price of a futures contract on an exchange is not arbitrary. It's a dynamic consensus that factors in all fundamental news from across the globe, from supply disruptions like strikes or floods to shifts in demand driven by industrialization or new technology. Second, and perhaps most critically, they offer a powerful mechanism for price risk management. Volatility is a given fact in the world of metals. A producer needs to hedge against the risk of falling prices to protect their profitability. A consumer, say a cable manufacturer or an auto component maker, which is a producer in itself down the chain, needs to hedge against rising input costs that would otherwise erode margins. Our exchanges provide the tools for this price insurance, allowing businesses to focus on production and innovation. The value of this function cannot be overstated. Third, our derivatives markets create a common benchmark for the entire physical value chain. The exchange traded price becomes a transparent reference for negotiations on quantity, quality, and location, thereby benefiting the entire ecosystem. This leads me to my next question for you. How can we increase awareness and participation, especially among SMEs, in these markets to truly de-risk our industrial backbone? How do we forge resilience in a turbulent world? We are living in an era of heightened geopolitical uncertainty. Trade tensions, supply chain disruptions, and tariff wars are no longer abstract concepts. These are daily realities that impact costs, production, and inflation. The recent doubling of tariffs on aluminium and copper imports by the US, for instance, is a development that directly affects India's export landscape. In such a volatile environment, a robust derivatives market provides a powerful shield, allowing Indian producers and consumers to hedge against global price shocks. This need for resilience is even more pronounced in the context of critical minerals. These minerals, like lithium, cobalt, nickel, and rare earth elements, are the building blocks of a green energy future. They are essential for building everything from solar panels to wind turbines to EV batteries and energy storage solutions. The Government of India has rightly recognized their strategic importance by launching the National Critical Mineral Mission to ensure a secure and self-reliant supply chain. Our markets will have an important role to play in achieving this critical national security objective. It's noteworthy that MCX has recently launched a deliverable nickel contract. This contract was very much needed as nickel is almost entirely imported into India. My question to you is this: what can our markets do as India pursues its goal of self-reliance in critical minerals? Can we develop financial instruments that help finance and de-risk the exploration and mining of these vital resources? So what's the way ahead? The journey from mines to markets is an ongoing one. Strengthening India's commodity markets is high on SEBI's regulatory agenda. We have, in fact, I would rather say, development agenda. We have already constituted a committee to recommend measures for deepening the agriculture commodities segment. We'll also constitute a working group for developing the non-agricultural commodity space, including metals. And we will bring all stakeholders, including many of them who spoke today, the investors, the metal makers, the producers, the financiers, into one group to see where all problems are and where are the pain points and where the development possibilities of market making and so on, and what role each one can play, including SEBI. Our approach will be multi-pronged. First, we'll continue to strengthen the integrity and safety of our markets. Measures like real-time margin collection and continuous monitoring are non-negotiable. Second, we will foster market development and innovation. This means encouraging our exchanges to constantly evolve. As metal derivatives grow, other peripheral services, for example, advisory, intermediation, financing, warehousing, and logistics, are also likely to grow in parallel. Third, we aim to deepen and widen participation. Our markets are for large corporations, traders, importers, and SMEs. They are also available for institutional investors like mutual funds and AIFs who are increasingly recognizing metals as an asset class that improves risk-adjusted returns for investors. And there are indeed some suggestions that MP has made today also, and maybe going to make, in regard to what we can do more. Enhanced institutional participation will bring in higher liquidity, making the market more attractive for hedging. We will keep working towards a regulatory framework to enable prudent institutional access to these markets. A proposal to allow FPIs to trade in non-cash settled, non-agricultural commodity derivative contracts is also currently under examination. We will also engage with the government to consider banks, insurance companies, and pension funds to trade in these markets. By December 2025 end, we will include commodity-specific brokers in the Samuhik Prativedan Manch, a common reporting mechanism for compliance reports. This will ease their compliance requirements. We have engaged and will continue to engage with the government to resolve GST-related challenges for participants who wish to receive or deliver commodities through the exchange platform. Fourth, we will run targeted awareness and education programs to make these markets more accessible and relevant to all. So the road ahead is exciting and challenging. We need to rapidly move from being price takers to price setters. We are aligning our markets with national priorities like Make in India and the critical minerals mission. We are building an ecosystem that is resilient to global shocks and responsive to domestic needs. So let's work together, regulators, exchanges, and market participants, to build a robust commodity derivatives market with metals at its core that truly creates value, manages risk, and will power India's journey to a brighter, more prosperous future. Thank you. Jai Hind.
Thank you so much, sir, for your insightful and inspiring address. Once again, can we give him an applause, everyone? All right, thank you, everyone. Requesting you all to please be seated. We move towards our next session, and the theme of the next session is Commodity Derivatives, the Next Leap. And now, I would like to invite on stage Mr. Devendra Surana, Managing Director, Bhagyanagar India Limited. They produce copper products such as rods, strips, pipes, bus bars, and sheets primarily for the original equipment manufacturers. Requesting Mr. Chitranjan Rege, Head Base Metal MCX, to please felicitate him. Thank you. Sir, requesting you to please share your thoughts with us.
Good morning, everybody. I've come from Hyderabad only for this session. Happy to be here, and it's nice to see all of us interested in the metal group. I have a small presentation which I would like to share with you. So basically, I'm from Bhagyanagar Copper. While I represent a lot of other organizations, I'd like to talk only about my company. We are one of the biggest importers of copper, which comes from all over the world, US, South America, and all over the places. And we make value-added products like sheets, foils, pipes, auto components, switchgear components, and others. We handle about 2,000 tons of copper a month, which have an exposure of almost 6,000 tons in a year. Oh, this year, sorry. So, why do I need to hedge? Copper is very volatile, margins are low, exposure is high. And I want to share experience. I'm one of the first people to start using the MCX platform. I've started hedging in the year 2007. And since 2020, I've been also hedging on LME. So